On Monday, May 18, 2026, a network of 9,276 physical crypto kiosks across the United States, Canada, and Australia went completely dark overnight. Bitcoin Depot, the single largest operator of Bitcoin ATMs in North America, filed for voluntary Chapter 11 bankruptcy protection in Texas. The company laid off its corporate staff and announced the immediate sell-off of its remaining physical assets. This infrastructure collapse occurred while the underlying asset was actually thriving. The price of Bitcoin itself remained heavily in demand, trading reliably between $72,000 and $76,000. While the digital asset held its value, the physical machines distributing it were abandoned in retail stores and gas stations. The company's CEO publicly blamed relentless litigation and shifting state regulations for making the business model impossible to sustain. To see what actually destroyed this massive retail footprint, we have to look past the official corporate statements. The real causes of death are buried in a devastating quarterly earnings report and a severe warning from federal law enforcement. This graph tracks Bitcoin Depot's decline. Q1 2026 revenue dropped 49% to $83.5 million. A $12.2 million profit inverted to a severe $9.5 million net loss as margins collapsed. Operations burned $21.6 million, leaving $44 million on hand, while stock plummeted 80%. The cash crisis accelerated in April 2026 when cybercriminals breached the corporate IT systems and drained $3.7 million directly from Bitcoin Depot's digital wallets. The security breach was a heavy blow, but the terminal illness, wiping out their revenue, was the sudden international crackdown on the machines themselves. The regulatory environment turned aggressively hostile starting in Canada, a move detailed directly in the government's Spring 2026 Economic Update. Finance Minister François-Philippe Champagne officially proposed a sweeping nationwide ban on all 4,000 crypto kiosks currently operating in the country. The proposed law effectively made it a criminal offense to operate the machines. South of the border, individual U.S. states imposed their own strict compliance obligations. Lawmakers introduced aggressive transaction caps, and Connecticut outright suspended the company's money transmission license. Governments moved to ban these machines because law enforcement agencies identified them as the primary infrastructure for organized crime. The catalyst for these bans was a public safety alert from the FBI's Internet Crime Complaint Center, detailing specific criminal activity flowing through physical kiosks. Looking at 2025 Bureau data, the FBI logged 13,460 crypto kiosk complaints, accounting for over $389 million in stolen funds, a 58% surge. The data exposes that adults aged 50 and older suffered the vast majority, with $302 million siphoned directly from them. The operation followed a precise psychological script. Fraudsters impersonated tech support or tax officials, manufactured an urgent crisis, and directly instructed the panicked victims to drive to their local bank and withdraw their entire savings in physical cash. The final step required the victim to take that cash to a nearby crypto kiosk and scan a malicious QR code provided by the scammer. The machine then instantly routed the deposited funds into an untraceable criminal wallet. The physical ATM model imploded because it had mutated from a consumer convenience into a highly efficient funnel for predatory extortion. The removal of 9,000 physical machines from gas stations and strip malls did not damage the broader crypto ecosystem. Instead, it purged a layer of the market that had become deeply associated with fraud. Retail consumers had already abandoned the physical kiosks and their predatory 8 to 20% markup fees. Trading volume migrated online to regulated digital exchanges. Access to the asset is now handled through regulated spot Bitcoin ETFs and major fintech applications, allowing investors to participate without ever touching physical cash or a vulnerable kiosk. The bankruptcy of Bitcoin Depot dismantled a major channel for kiosk-based extortion, signaling a transition toward more regulated and transparent digital access.